Hey everyone, welcome to Tax and Accounting Tips, short videos designed to get you a bigger tax refund, protect you from laws, or just give you peace of mind that if the IRS comes knocking at your door, you've done things right. If you donate to charitable organizations, you might want to consider establishing a donor-advised fund. A donor-advised fund is a charitable tax-saving tool that enables you to maintain a certain level of control over how the funds are distributed while receiving immediate tax benefits. Opening a donor-advised fund is like starting a charitable investment account where your money can grow tax-free and be used to support nonprofit organizations you're choosing. Even better, you can claim an immediate tax deduction for funds placed in the account, enabling you to reduce your adjusted gross income while still contributing to the greater good. Well, let's start with a brief explanation of how the donor-advised funds work and then move on, to the associated pros and cons. A donor-advised fund is established by making an irrevocable contribution to a fund that is controlled and managed by a sponsoring organization. The sponsoring organization is typically a bank, financial institution, community foundation, or an individual charity that will invest the money where it grows tax-free. You'll receive an immediate tax deduction for the amount contributed up to a certain limit. Beyond that, the deduction can be carried forward up to 5 years. As a donor, you can recommend how the fund should be donating, and as long as the funds are donated to registered 501c3 organizations, charities, and they don't provide any personal benefit to you, the sponsor will typically carry out the donor's recommendations. Also, there's no time frame for when the funds must be dispersed, but the funds must eventually be donated to registered 501c3 organizations. So that's how it works. But what are the pros? Number one, it's a great way to save on taxes and support charities that are near and dear to your heart. Aside from that, you can maximize the deductions now while being able to contribute to the charities over an extended period of time. If you donate year after year to a charity, you only receive a tax benefit in any given year if you itemize deductions on your tax return. That means you have to exceed the standard deduction. And you probably know that the standard deduction is very high right now. So that's hard to do, especially if you don't have a big mortgage on your house. But by aggregating your charitable contributions into a single year using the donor-advised fund, you're better able to exceed the standard deduction and maximize your itemized deductions. Bottom line is you'll be able to take the charity deduction now instead of waiting until the actual donation is made to the charity. Another pro is that many charities are not set up to accept non-cash donations such as public securities, restricted stock, private equity positions, or shares of privately held companies. They're just set up to receive cash. But with a donor-advised fund, many sponsoring organizations will make it very simple to contribute these kinds of assets to your fund. So that's something that might help you. Here's another pro. With a donor-advised fund, you can reduce or avoid capital gains tax on appreciated assets. And if you contribute appreciated assets to the fund, you can avoid being taxed on the capital gain as long as the asset is being held for at least a year. For appreciated assets, you can claim an immediate tax deduction of up to 30% of your adjusted gross income. That's less than the 60% limit for cash donations, but at least you have the flexibility to contribute a combination of appreciated assets and cash so you can maximize the total deduction in your particular situation. And here's another pro. Your charitable contribution can grow tax-free. While donor-advised funds grows, it's not taxed. So an initial donation of say $20,000 could eventually grow to say $30,000 in your charitable funds, to chosen nonprofits over time. Another pro is that your donor-advised fund can last in perpetuity. You can appoint co-advisors and trustees, and heirs and loved ones will always have input over how the donor-advised funds are dispersed. Finally, a donor-advised fund can reduce your paperwork. With donor-advised fund, you can give to various organizations over the year and receive a single document outlining all your charitable donations. This is a bit simpler than tracking 20 different donations to nonprofits. Okay, so what are the cons? Well, one thing is that donor-advised funds are irrevocable, so you can't get your money back for any reason. The next thing is that donor-advised funds are managed by a third-party sponsor. Even though you can make recommendations on how your funds are donated, you don't technically have the final say. But with that said, most sponsors will act in accordance with your recommendations as long as the recipient is an eligible charity. Another problem might be that many donor-advised funds require a minimum investment and do have fees for maintaining the account. While you can make a $500 donation to a local charity, it's unlikely that you'll be able to set up a donor-advised fund with anything less than $5,000. As for the fees, most sponsors charge an annual fee based on the amount held in the fund. Typical fees are not erroneous, but do reduce the amount eventually donated to charities. Finally, you may not like the investment options provided by the sponsoring organization. So for this reason, you'd want to research investment options provided by the sponsoring organizations under consideration. Well, I just threw a lot at you of information at you, but if this tool sounds like something that would help you achieve your charitable giving and tax minimization goals, give us a call so we can discuss it further. Thanks and have a great day.